Imagine waking up one day to find out that your money is worth less than it was yesterday. Shocking, isn't it? This is not a plot from a dystopian movie, but a reality many face due to a silent thief known as inflation. Inflation, in simple terms, is the rate at which the general level of prices for goods and services is rising. As inflation surges, every dollar you own buys a smaller percentage of a good or a service. Over time, it erodes the purchasing power of money, silently and steadily. It's like a stealthy burglar quietly breaking into your house at the dead of night, not to steal your belongings, but to make them worth less than before. Inflation is a normal part of a healthy economy, however, it becomes a problem when it's too high, too fast. And while it's true that your money in the bank is safe from thieves and disasters, it's not safe from the stealthy, relentless thief of inflation. You see, a simple savings account may not be able to combat the effects of inflation. Let's say the annual inflation rate is 2%, and your savings account earns an annual interest of 1%. In such a case, you're essentially losing 1% of your money's value each year. Now, that might not seem like a lot, but over time it adds up. And if the inflation rate outpaces the interest you're earning, your hard-earned dollars are effectively losing their value without you spending a single cent. So, how do you protect your money from this silent thief? Well, the mattress or the cookie jar won't do, and while a savings account is a good start, it's not enough. You need something more, something that not only keeps up with inflation, but potentially outpaces it. But don't worry, there's a way to fight back against this silent thief, and that's through smart investing. Yes, you heard it right. Investing is not just about making more money, it's also about protecting the money you already have from the silent, stealthy thief of inflation. Ever heard of the stock market? It's not just a playground for the rich and famous, it's a place where ordinary people can invest their money and potentially see substantial growth over time. You see, when you buy a stock, you're buying a piece of a company. As that company grows and profits, so does your investment. Now let's compare this to a traditional savings account. With interest rates often less than 1%, the money you have sitting in a savings account is likely losing value due to inflation. But stocks? They have the potential to give you a much higher return. But don't forget, the stock market isn't a one-way street to riches. It's volatile. It's unpredictable. It can go down as well as up. That's why it's important to understand the risks before you dive in. Remember, while stocks have the potential for high returns, they also come with risks. So always do your due diligence. When you think of real estate, you probably think of houses and buildings. But did you know that it's also a great investment? Yes, indeed. Real estate goes way beyond being just bricks and mortar. It's a tangible asset that, over time, appreciates in value, providing potential returns that far outstrip those you'd get from a regular savings account. But like any other investment, it's not without its risks. Market fluctuations can affect property values, and maintenance costs can eat into your profits. Also, it's worth noting that real estate isn't a liquid asset. You can't quickly convert it into cash. However, with careful planning, a good understanding of the market, and a well-chosen property, real estate can become a lucrative investment. It can generate a steady income stream through rentals, and the property itself can appreciate in value over time. Real estate can be a great way to grow your wealth and beat inflation. But as with any investment, it's important to do your research. Bonds may not be as exciting as stocks or real estate, but they're a safe bet when it comes to beating inflation. Now, you might be wondering, why bonds? Well, they're like the tortoise in the classic race. They may not sprint ahead with flashy returns, but they consistently plod along, delivering steady income over time. Let's put it this way. Imagine your money is a seed. You could plant it in the risky soil of stocks, hoping for a bountiful harvest but risking a poor yield. Or you could plant it in the safe, fertile ground of bonds, where growth might be slower, but it's also more certain. When compared to a savings account, bonds typically offer higher interest rates. This can make them a more attractive option for those looking to grow their money, but who also want to avoid the roller coaster ride of the stock market. While bonds may not offer the highest returns, they're a relatively safe way to grow your money and stay ahead of inflation. Want to invest in stocks, bonds, and real estate all at once? Then mutual funds may be for you. These investment vehicles allow you to invest in a diversified portfolio with just a single transaction. Instead of picking individual stocks or properties, a professional manager does the heavy lifting for you. Now let's talk about potential returns. With a savings account, you're looking at a measly 1 or 2% interest per year, barely enough to keep up with inflation. On the other hand, mutual funds, while they do carry more risk, have the potential to offer significantly higher returns. But before you dive in, remember that all mutual funds are not created equal. Some focus on high-growth tech stocks, while others may invest in stable, income-producing real estate. So it's crucial to understand the fund strategy and risk profile. With mutual funds, you can diversify your investments and potentially beat inflation. But remember, it's important to choose your fund wisely. Gold has been a symbol of wealth for centuries, but did you know it's also a smart investment? This shiny metal has a few tricks up its sleeve. For starters, gold tends to maintain its value over the long haul, making it a strong contender against inflation. It's also a reliable buddy during economic downturns, often seeing its value increase while other investments take a hit. But it's not just about the glitter of gold. It's crucial to remember that gold doesn't produce dividends or interest, unlike stocks or bonds. Its value is primarily driven by market sentiment, which can be as fickle as the wind. So let's put this in perspective. Say you've got a savings account. It's safe, sure, but with today's low interest rates, it's probably not keeping pace with inflation. Gold, on the other hand, could potentially offer a better return over time. Gold can be a hedge against inflation and a safe haven in times of economic uncertainty, but like any investment, it's not without risks. Cryptocurrencies have been making headlines for a few years now, but are they a smart investment? Welcome to the digital frontier, a realm where traditional investment strategies are being challenged by the rise of cryptocurrencies. These digital currencies, such as Bitcoin, Ethereum, and many others, represent a new form of asset, one that exists purely in cyberspace. So what makes cryptocurrencies so enticing? For one, they offer a potentially high return on investment. In the past decade, early adopters of cryptocurrencies have seen their investments skyrocket. Bitcoin, for instance, was worth less than $1 when it was launched in 2009. Fast forward to today, and a single Bitcoin is worth thousands of dollars. However, it's not all sunshine and rainbows in the world of digital currencies. Cryptocurrencies are known for their volatility. Their value can change rapidly, often swinging wildly in a single day. This volatility can lead to significant gains, but it can also result in substantial losses. Now let's compare this to a traditional savings account. A savings account provides a safe, steady return on your money. Yet, the interest rates are often so low that they barely keep up with inflation. Cryptocurrencies, on the other hand, offer the potential for much higher returns. But with this potential comes a higher level of risk. It's much like a roller coaster ride. It can be thrilling, but it's not for the faint of heart. So, are cryptocurrencies a good investment? That ultimately depends on your risk tolerance. If you're the type of investor who can handle high volatility and is willing to take on more risk for the chance of higher returns, then cryptocurrencies may be a suitable option for you. But remember, never invest more than you can afford to lose. Cryptocurrencies offer a potentially high reward, but they're also highly volatile, so invest with caution. Welcome to the era of digital currency, where the risks are as real as the rewards. Want to invest in a variety of assets without the hassle of managing them? Then ETFs may be for you. Exchange-traded funds, or ETFs, are investment funds traded on stock exchanges. They're like a mixed bag of sweets, providing exposure to an array of assets, such as stocks, commodities, or bonds. This way, you're not putting all your eggs in one basket. But remember, with great potential returns comes great risk. The value of an ETF can go down as well as up. It's a bit like riding a roller coaster. Some days you'll be on the thrilling highs, and others you might experience stomach-churning lows. Now let's compare this to a savings account. Sure, it's safer, but the interest rates are often lower than inflation. It's like walking on a treadmill. You're moving, but not really getting anywhere. ETFs offer the potential for high returns and diversification, making them a smart choice to beat inflation. Ever wished you could be the bank? With peer-to-peer lending, you can. Imagine this: instead of depositing your money into a savings account and earning a measly interest rate, you lend directly to individuals or small businesses. You set the terms, you set the interest rates. That's the beauty of peer-to-peer lending. Now, let's weigh the potential benefits against the risks. The returns can be attractive, often outpacing what traditional savings accounts offer. But remember, higher returns also mean higher risks. You're dealing with individuals and small businesses, some of whom may default on their loans. There's no FDIC insurance here, folks. Also remember that your money isn't as liquid as it would be in a savings account. It might take some time to get your money back if you need it. Peer-to-peer lending can offer high returns, but it also comes with its share of risks. So proceed with caution. Now that you know about these 10 investments, it's time to take action. It's time to put those idle dollars to work. Investing is not a spectator sport, it's an active engagement. You're not just parking your money somewhere, you're making it work for you. Inflation, the silent thief, is always on the prowl, and it's never been more important to stay one step ahead. But how do you do that? By investing wisely and diversifying your portfolio. Diversification is not just about spreading your money across different investments, it's about reducing risk and maximizing returns. It's about having your fingers in different pies. So if one doesn't do as well, you've got others to fall back on. But remember, while investing opens up opportunities for growth, it also comes with its fair share of risks, and that's where doing your own research comes in. It's essential to understand what you're investing in, the potential returns, and the associated risks. Don't just follow the crowd or the latest trends. Be informed, be smart, be strategic. There's a world of investment opportunities out there. Stocks, real estate, bonds, precious metals, cryptocurrency, peer-to-peer lending, and more. Each has its own potential for returns and its own risks. So, take your time to understand each one, and then make an informed decision based on your financial goals, risk tolerance, and investment horizon. And if you're feeling overwhelmed, remember, you don't have to go it alone. There are financial advisors, robo-advisors, and investment platforms that can guide you through the process. They can help you build a diversified portfolio that aligns with your financial goals and risk tolerance. Investing is a journey, and like any journey, it begins with a single step. So, don't delay. Start investing today. Start small if you need to, but start. Every day you wait is a day inflation is stealing your purchasing power. Remember, the best time to start investing was yesterday. The second best time is now. So start today and outsmart the silent thief called inflation.